Right.
All right, everybody, welcome. It is Wednesday. We're coming to you live from Investing Education Academy. For the next couple minutes, or for a nice little while, you have myself, Brent Simpson, and Leon Noble to ask questions, to engage. It's a perfect time to do so. But one of the things that we haven't been asking that I'm going to ask this time is that if you have a group of people who you know probably need to know a little bit more about investing, the world of stocks, please share this video with them, tag them, and also throughout this conversation, we want it to be a conversation. Comment, if you have questions, let us know what the questions are. If you have comments, also please put your comments in the notes below. And if you're listening to us on the podcast later on, we rest assured we will keep you kind of abreast on why we're answering certain questions, where they came from, and why it's applicable to anybody who's listening to our podcast later on the IEApodcast.com platform. So we have a topic today. It's really one of those things that a lot of people need to know. It's about what should you look for when you're researching stocks? We get that question all the time. So while Leon tells you more about why we chose the topic and what it means to do that, I'm going to do a little bit of housekeeping.
Yeah, so this topic is our number one asked question. Like, this is the number one thing people ask us is, what do we look for when we're researching stocks? And we get it. But the reason Brent and I have a lot of times have a hard time explaining this to people is because we do it two separate ways. We research stock two separate ways. We have some similarities, but we do it two separate ways. And when we do look, we do a lot of research, right? So we dig kind of deep into the company. Brent's very big on management and product. I'm very big on the actual numbers, the revenue, the cash flows, things like that. So we look at a lot of different things. So when someone says, hey, what do y'all look for when y'all research stocks? It's kind of like, we could have a whole hour, 2-hour discussion on that. So it's kind of hard for us to answer. So today, what we're going to do is we're going to give 4 of the more important points that we look for when we research stocks. This isn't it by any means. I mean, there are hundreds of data points and pieces of information that you really should look to when you research stocks. But these are like I always tell people, if you don't have the time to really research stocks like that, the top 2 for me are just revenues and revenues and profits. But we're going to talk about 4 total today. But if that's as much as you can do and you have a lot of time in your hands, just profits and earnings, you want to see that those are growing. But we're going to dig a little deeper into 2 others today. We're going to talk them through. So Brent, you get it set. You can throw up the slide 1.
Yep. So here we go.
And so like I said, this is our number. This is most likely our number one asked question. And I mean, it makes sense too, because I'm a big data guy, right? So I need to see the data. I need to see what the company's doing, why it's doing it, how long it's been doing it, and how successful or not it has been doing it. And Brent and I we're just like everybody else, right? Like we look up stocks, and what I find is that it's often hard to find a lot of information on companies, right? At least their financials. It's all out there. It's like we always say, one of the best resources. It's free. It's Yahoo Finance. But you still got to know what to look for, right? And you still have to know what it means, and you also want to do like comparative analysis against other stocks. So it can be a lot of work. But to make things super simple and to make things cut and dry, especially for people that don't have a lot of time, we're going to cover these 4 here. And so the title of this is what information to look for when you're researching stocks.
And also, Leon, we're not going to go into it now, and we're going to be doing a rollout inside of IEAmembers.com or the Investing Education Academy community. But Leon's actually been developing a platform, a software that kind of is going to make a lot of what we're talking about today automated for people who are interested in that tool. I know that's a teaser. I know it's a cliffhanger. I'm doing it on purpose. But I do want to let you all know, like, one of the things we've heard is you all's request from before, Leon was building it just for himself, but looking, after having conversations and looking at the need of so many people, like, how do I automate this process? Like, I'm not going to go through all the financials. It's something that we're working on. Leon's, definitely leading that charge. And I'm just trying to make sure he gets it to the community that needs it, because it needs to be public. So, we're going to jump into earnings per share. And 2, I really want to push that Yahoo Finance that Leon talked about. all this stuff is on Yahoo Finance, and YouTube is a great resource when you're trying to figure this stuff out. And it's like we get these pieces of it, and many of us do this in business. We get pieces of things, but we don't know how to put it together. So as we talk today, we're going to be kind of jumping in and out of conversations with each other, so you all can kind of see a process on some of the things that we would talk about normally if it was just us on the phone.
Right. Yeah. And I mean, like Brent said, all this information is at Yahoo Finance. It's a great resource. But the problem is, and then like, I'm just going to shout out one of our members, Yao. He's like me, right? He's a big research guy. He looks up a lot of information. He does a lot of research before he looks to buy stocks. And he's big into options too. But he's a guy who's dedicated to it, like I am. And he even finds it hard to find information, like a lot of this information. And then when you find it, it's like, what does it mean? What does it mean in relation to other companies when you do kind of a comparison? So even someone like Yao, who's kind of a research nerd like me, still finds it hard. And even like for me, that's why I'm building that platform, is because again, it's hard to find. I mean, and I'm just saying this: there's 7,000 plus stocks, publicly traded stocks right now, and it's hard for all of us to do even one or two, much less 7,000. And then you're talking about 7,000 and look at all these different data points. So it just gets to be too much. So to keep things simple, to keep things kind of top of the line, we're going to cover these four, right? So first one, the most important one, the one that most people think drives stock prices, are earnings or profits. The Wall Street term is earnings. You can also say profits. Now, you notice the first one has two examples. One is earnings, then the other one's earnings per share. So earnings is going to be the big number, right? That's going to be the amount of money they made in the quarter or for the year. So it may be like, 200 million, 300 million, 500 million, what have you, as the earnings. But then you have earnings per share. They're just taking that big number and dividing it by the number of shares outstanding. So that number will go, so you'll have the big number, the actual earnings may be like 200 million, but the earnings per share may be like 50 cents, right? Because they're taking that big number and dividing it by the number of shares outstanding. So they're both the same thing. It's just kind of the way you look at it. Most investors on Wall Street look at earnings per share versus earnings. They look at it per individual share. And like I said, most on Wall Street, the theory is that earnings drive stock prices. So growing earnings is very, very, very important. Year to year. So for me, I look at 3 years or more. I look at minimum 3 years. So I want to see 3 years of earnings growth, over the 3 year period.
Yeah, I know we look at 5. And so 5 is like, if you can find a company with 5, I love the 5 time frame.
Right. And the way I do is I do the average, right? So it doesn't necessarily have to be growth every year, but as long as over that 3 years, or if you're going Brent's 5 years, as long as the average is positive. Again, that's what I look for. Second one is revenue, right? So revenue is very, very important because revenue is the backbone of the company, right? So I'm going to say something also about earnings. Earnings can be kind of manipulated by accounting, right? So earnings can look a lot better than they actually are. There's a lot of Wall Street shenanigans that go on to make things look better, for shareholders, if people don't buy their price. One thing but you can't really, well, not say you can't, but it's harder to manipulate is revenue, because revenue is just the total amount of money that comes into the company. So it's a raw number, right? So, and then earnings or profits are based off of revenue. So you also want revenues to be growing, because as revenues grow, if everything's going well and they're controlling their costs, their earnings should grow as well. If you see a company with dropping revenue, but growing earnings or profits, that's a bit of a red flag, because if their revenues are dropping, that means they're probably either they're controlling their costs really, really good, or they're doing some financial shenanigans to make those earnings or profits look better. So growing revenue.
Got a question came in.
Oh, go ahead.
And so the question is earnings per share, is that revenue or profit? And earnings per share is essentially talking about how much the stock is making relative to each share. And so when you look at revenue is the overall income that the company is bringing in, top line. So when you look at top line, revenue is not the same things. It's how much they earn relative to each share they have outstanding.
Yep, and that's profits. Yeah, that's that earnings or earnings per share are the profits. And
based it to a per share piece.
Per share, right? Yeah, earnings per share is profits per share, and then earnings that's the big number. So earnings per share is based on profits. But as I said, you don't want to see a company with falling revenues and rising profits. I mean, it's good. I mean, more profits are always better, but profits come out of revenue. If revenues are falling, that something's wrong. The product isn't selling. The product isn't selling, as it was before. So again, for me, I look for 3 years of average revenue growth to be a positive number. So again, not every year has to be positive, but as long as over that 3 years it averages out to a positive number, that's what I look for. And
Leon, let me just touch. When you see companies with falling revenue, but their earnings per share seems like it's going up, or it's not going down relative to how much their revenue is shrinking, you have to look at leverage money. How is this company leveraging? I'm bringing in new money. Basically, I'm trying to think of a better way to explain leverage money. How much money are they borrowing to sustain the overall picture of the company? So money into a company isn't always, but a loaned amount is not revenue. So companies can leverage money and then kind of keep everything looking great. Like Leon said, you can manipulate the earnings per share number a little bit, but revenue you can't. So just understand what leverage money means and how companies borrow. But I don't want to go into that right now, so I'm being careful on how I say it, but just it's a thing.
Yeah, definitely. Yeah, borrowed money can be risky because that's more debt. So you want to see growing revenues and you want to see growing profits. Those are, like I said, most of Wall Street go by the stance that profits grow stock prices. Now, if you look at a lot of companies that are public now that are the stock prices going through the roof, they have absolutely no profits. Some of them barely have any revenue. So we're kind of back to the days, the .com days, when you threw a dart at something and it went up. Typically, this ends badly, like it did in 1999. At some point, there's going to be a reckoning where all these weak, quote unquote, weak companies with either slow or no revenues or slow or no earnings, they're going to come home to roost, right? These things are going to eventually come back down to earth. So to kind of avoid all that drama when it does happen, you want to look for companies with growing revenues and growing earnings and or earnings per share, because that's a solid foundation a company is built on. Third one is price to earnings ratio. So this is a metric of value. This is a metric to see if a company is expensive or not, right? And it's very simple, right? So the higher the number, the higher the PE. So price to earnings ratio or PE ratio. We're just going to call it PE ratio. The higher the PE ratio, the more expensive the stock generally is. I'm not going to go into the math or the calculations behind it. If you want to, you can Google it and kind of see how it works. But just know that the higher the PE ratio number is, the more expensive the stock is. And if you want to do a comparative analysis, which I highly recommend on anything, look up the PE ratio for the S&P 500. And right now, I think it's like 23, 24. So kind of use that as a baseline and say, okay, if a company has a PE ratio that's higher than that, that company is quote unquote, by that metric, it's expensive. Companies that have, PE ratio of say 15 is going to be less expensive than the overall market. Now, say all that to say, growth companies that are growing their either the revenues or the profits, or companies that are perceived to do that later in the future, typically tech companies, they're going to have PEs that could be in the hundreds. Or so you may have, say what?
In the 200s sometimes.
200, yeah. You could have. I think Zoom at one point, its PE was like, I think over like 1,000.
Yeah. That's a good point, Leon. That's a good point. Like, if you all are looking at PE ratios and you notice that they seem like they're high relative to what compare it to the industry that they're in, number one, and then compare it to their circle of competitors. Because sometimes it might be normal in, let's say, a tech company. A lot of these tech companies right now may have PE ratios that are 200, 150 or higher. If this were, a true and value investing ecosystem, you run to the hills. It wouldn't touch it with a 10-foot pole. Or like a Warren Buffett analysis on it is like, I'm never going to buy that. However, those companies, normally these growth companies that are out there, they grow very quickly, and the market is used to a PE ratio that might be 150 or more on certain types of stock, like Workhorse. You have Tesla at one point, Zoom. The list is highly extensive, but they broke 100, and that's why I say you have to look at the sector.
Yeah, that's a very good point. Yeah, the S&P 500 is a general market, but that's a good point. The sector is actually more important because you'll find in tech, like right now, if you look at PEs in tech, the average PE in tech is probably like 70, 80, 70, 80. The P is probably 70, 80. Whereas again, the S&P 500 is in the 20s. But if the average for tech is 90, let's say 90, and then you have a company that's at like 60 or 100, it's not that bad, right? It's kind of near the average. But if you compare that to the S&P 500, which is 20 something, it's going to seem high. So it's a very good point. It's better to compare PEs to the sector or the industry's PE. Now, I will say that's hard to find. It's hard to find the average PE for a sector or industry. It'll be a little easier to find the S&P's PE. It's still not as easy to find, but a sector PE is going to be hard to find. But if you can find it, definitely use the sector PE over the S&P 500 PE.
Yeah, and for anybody who's thinking, well, okay, this sounds like a heavy lift. You guys are going crazy right now. So if you go to Yahoo Finance, there's actually a tab that tells you the sector of the stock that you're looking at. So you don't have to guess. You don't have to wonder, like, how do I even know what sector this stock is even in, right? Because I know some of you all are thinking that. Like, you all are saying a lot of stuff that some sticking, some's going over my head. Some I just don't care about. Some I love it. And there's all different types of people right now who are taking in this information. Understand that when you go to like a Yahoo Finance, or if you put the stock into a Google search that you know the name of the company, and you might just say, what sector is this company in? It will more than likely list it. And even when that happens, I will go to another browser or another search engine and type the same question, just so you can kind of cross-reference, because not everything you find in a Google search is true. So just think about that. Like when you're trying to figure out what sector is it in, just Google, ask Google, ask Bing, ask Yahoo Finance, whatever it might be. But again, it is listed in the section when you look up a stock on Yahoo Finance. It says sector, and you can actually see the sector. Once you find out the sector, you can go back to a Google and say, Google, please tell me the average PE ratio for a stock in blah, blah, blah stock sector. And it might make the search easier. All right, so the next one, let me make sure I can bring Leon back in. I lost him for some reason. While I'm bringing him back into the Zoom, you all, when you're looking at these stocks, right, it seems convoluted, if you will, to go through the total analysis of the stock. We're looking at earnings per share, we're looking at the average in the industries, and if we're looking at a baseline of S&P 500 with 40 or 38, and then you're looking at your industry, if it's tech, where it can be 90 and above, and you're thinking, what the hell does this mean? Maybe that's not the metric that you should use. Or maybe you should get some education on how to use the metrics, i.e. join IEA. And so, in this space, another one that is not on the list that I think is very important is news. You got to know what's going on with the company. And sometimes news can be a great indicator of what is to come. So we're going to go into the next one.
Yeah, sorry about that. I got dropped by for some reason.
That's all good. That's why it's two of us. And so operating cash flow, we're looking at cash flow. Oh, go ahead. You can jump into this.
Yeah, so operating cash flow is important because, okay, so you have there are a bunch of different cash flows. You have two of the biggest are operating cash flow and free cash flow. So I prefer, well, they're both important, but I prefer operating cash flow because what operating cash flow tells you is how much cash is coming in the business from what the business focuses on, right? So if a company sells widgets or they sell tables, right? But let's say they also have real estate. Maybe they have an office they rent out. I don't care about the revenue that comes from that office, because that's not their core business. Operating cash flow tells you the cash that comes into a business from its core business. So that's the number. That's the cash flow I mainly look at, because I want to see the core. Because if the company sells tables, but they're getting most of the revenue from this office that they're renting. That's not what I invest. I didn't invest in a real estate company to rent out office. I invested in a company to sell tables. And so, if I know that they're not making most of their money from the tables, but they're making most of their money from the real estate, that's not what I invested for. And I'm moving on to the next business. So operating cash flow will tell you the amount of money a company's making from their core business. And I will say free cash flow is another one to look at, but that'll tell you basically how much money. So free cash flow is actually the real profit of the company once everything is paid. Like it's like the total. Like I said, earnings can be manipulated by accounting tricks. Now, not saying that earnings are not true; they are true. but things can be they can be massaged. Where if you look at free cash flow will tell you the exact amount of money a company has now on the balance sheet they can use for whatever. But like I said, on Wall Street and most investors, they look at earnings or earnings per share and believe that's what drives stock prices. So that's why that's probably more important.
Yeah, and so I want to go back real quick and go back to the news piece and also management. Those aren't on here, but when I am particularly looking at certain stocks, that's very important to me. You know, who's in management position, what is their background in management, how successful have they been, you know, in the various positions of companies, and also how aggressive are they? Because you can get a company, because if you understand a company's culture, it can help you understand why they buy and sell goods and services the way they do, and if it makes sense in a particular environment. So for instance, I mean, it's the easiest one is Tesla, right? We all know Tesla. At one point, Elon investing in Tesla honestly made no sense. Like probably about 2018, 2019, Tesla themselves weren't even committed to keeping the company going. And people were still buying into the company because of Elon Musk. And so one of the things that I looked at when I was buying the company, or even going back to Solar City, which was a very literally close cousin to Tesla.
Yeah.
Right. It's when I first got Solar City, when I purchased Solar City, I don't even remember the year, but I knew Elon Musk was a chair for the board of advisors, and he essentially placed his cousin as the president of the company. I would say arguably just to keep the attention away from himself while he built Tesla. And so I was buying Solar City because of Elon Musk involvement. I wasn't even buying it for them. But when news came out that the acquisition of Solar City into Tesla came out, I bought more Solar City because I knew those cheaper shares would convert into Tesla shares later. And so I moved on the news. That's something that I would say you want to do it when you're more experienced with the market, because you know the patterns of the market. And that's why when Leon and I talk about you all being involved with our ecosystem, investing in general, there are certain things that new investors or new people who I see consulting, honestly, they've been in the market for like 10 years or 5 years, and they start trying to teach people about stocks. And truthfully, if Leon and I, either of us walked into a room, we could really hurt your feelings with how much we know about stocks, because we not only understand the technical side that, either of us know it, we don't move on it the same way when researching stocks, but we know it. But we also know the relationship that a stock or a sector has with the general population, right? And that's something you really don't know until you've been with the market for a while. It's really like a relationship. So like when we talked about Apple doing the IPO and we announced it inside of the Investment Education platform, people in our own community were like, we're going to wait for the split to happen because it's going to be cheaper. Leon and I were like, oh no. So we went live like that night inside of our platform, and we had a conversation with our members like, that's not the way this works. For the average retail investor, their mentality is, oh, stock is cheaper when it splits. So that's when they're going to wait to buy it, which is already going to be an inflated price, which after the purchase is probably going to drive the price. The price is going to correct. And they're going to be buying it at the high level and then experiencing that price correction. But that's something that we've learned from understanding the relationship to how the market responds to news and to a split. But that takes just years of experience. And so when you're out there and you're listening to these like so-called gurus, and they're telling you about the bond markets and yields and inverse yield curves, and they really don't know what that means. They don't even know what the 10-year treasury, like, what is that? I don't know. What does that have to do with mortgages? I don't know. What does that have to do with the prime rate? I don't know. And so how does that affect how businesses, borrow from the Fed window? I don't know. And so all of these become a chain reaction of like, I don't know points, but I know I heard on YouTube it's cool. So now I'm trying to teach it to these other 15 people. And it's like, come on, you can't just take information you heard here and then go there and then take information from there and go there. So really just know when you're sitting down with whomever, life insurance agents, options traders, day traders. They're like the worst. And no offense to any day traders out there, but day traders, I don't know. It's sometimes it's people who are addicted to the rush, but they don't know how to look for fundamentals of a company. In many of the companies, when you're day trading, they're small cap companies, or some of them are in the pink sheets. So they don't have a history to look at. So you have to look at a whole different sector of information. And so it's complex. It is complex. And that's why it takes time. And I'm saying all of this to say, if you're an investor and you're new to the market, I'm belaboring the point because it's really important. Give yourself time to understand the market. Give yourself time to, have a strong buy and hold strategy while also, exploring other endeavors. Because like Leon said, he's an options trader. I think, have you ever done day trading?
Yeah, I used to do it, and was not successful at it.
Yeah, I mean, day trading is one of those things you hear people tell their success stories, but they normally don't tell you how badly they lost. And
Oh,
so it seems glamorous and it seems like, oh, this is the holy grail. We in IEA right now today, there are stocks that we picked last year that are up over 300%. And we picked these stocks from a buy hold strategy, but these stocks are still up 300%. So buy hold strategy doesn't mean slow growth.
Right. And think about that. If somebody had day traded those stocks, they would have missed out, because these stocks, we were in these stocks 6, 7, 8 months and we're up 300-400%. If somebody traded in now, they may have made 5-10% maybe in a day, but lost out on another, 390 or some odd points. I want to make one other point about news. News often does not drive stock prices, but it does add volatility. So you can, story comes out, stock pops, everyone thinks, oh great, I'm gonna jump on board. And then in the next week to maybe a month, the stock is, you lost your money because you bought it when the pop happened. It's almost like an IPO. You buy it on that pop, it runs up, it kind of settles in, then it turns over. News is fleeting, right? No, a company's stock price can't be built on news. It's built on fundamentals. But on the short term, it can be. Like I said, it can add volatility. So yeah, stock can jump up and maybe even sit up there for a while. But over time, if that foundation of its earnings and revenues aren't there, Wall Street's going to realize, okay, this, we've given this company long enough. It hasn't shown us, and then they're going to sell. So what news is important, but news is only a very, I would say it's more the least important points, because you want it to be built. You want a company's foundation of a company built on earnings and revenue and a strong product versus news. But news is important. News can in the short term move stocks.
Yeah, and to that point, Leon, I agree. And you got to think about some of the news that comes out. It is already old. It's already been digested by Wall Street, and they've anticipated it. So it's already into the adjusted in the stock price. But when the retail investor receives this information, they think it's new news. And to Wall Street, it's old news, and it's already in the price. And now you're buying it up, and and then you realize, like, oh God, it's really no fundamental change in the company. Like it was just hype, or and this happened with Workhorse. It was all this news around Workhorse doing, I think it was a contract with the United States Postal Service. It would have been the biggest the contract would have accounted for 90% of the company's revenue. But you wouldn't know that if you didn't understand the fundamentals and understand what their revenue looked like to know what that contract meant. But if you just listen to the news like this, they were saying, oh, this contract for Workhorse may be the biggest contract has landed since opening. This can change the whole trajectory of the company. But you didn't know the fundamentals meant that if it didn't receive that contract, you're talking about a projected 90% loss in future revenue. And don't forget, everybody, please remember this. The stock market is forward facing. So if the stock market is forward facing and you're getting this news with projections of what might be that never happens, then what? Like Leon said, the market is going to correct. And most of the time, you're not going to get that news until after it's done. How many people bought like AMC or GameStop after all the hype, thinking, oh, it's going to keep going because a couple blogs said that it's the thing. I read
look at that. I checked that GameStop, I think, closed at $49, or when I checked it, it was $49. That's down from $483.
Yeah, I think AMC's at $5.
Yeah. So Yeah.
It really, you really want to look at these things that when companies don't have revenues and they're just trading on hopeful news, understand what are earnings per share, what is their revenue, what do the P ratios look like, what is the operating cash flow, and for me, I also want to know what does management look like. And again, one other thing I look at for companies: how many consumers, how big is the consumer marketplace? Because if it's an amazing company, but their total consumer market base is like 10 million people, that's not a lot of people. Like, it's only so much they can do in that space. But if it's like a billion, I'm like, okay, they at least have the opportunity to service a billion. Of course, there's a lot of factors. How much does the price cost? But just overall, if a company has a very small market that they can even acquire, it's going to hurt them as it relates to them growing their company. Because even if it's a great product, it's only so many people that can buy it.
Yeah, what you want to look for that is called total addressable market, or TAM, TAM. If you Google that,
pull out the TAM, but okay, go ahead.
Yeah, I mean, hey, it's Google. Yeah, Google, just Google total addressable market, or TAM, TAM, and for that industry or for that stock or whatever, and you should be able to get some sort of information on how big the market is. But that's a good point. Yeah, I mean, if the company, if the total addressable market is tiny, they can only grow so much, and therefore, it's probably not the most sound investment. So you definitely want companies with large total available markets, addressable markets.
I'm just looking up. I was seeing if I could find where it said the sector, so I can give people a real understanding of it. So let me see, profile.
Yeah, maybe a profile
right here. So again, we talked about this earlier, and Investment Education Academy, we're not gonna leave you hanging. It's right here. So if you go into a stock, again, Yahoo Finance, and you're like, what sector is this? The sector's right here. Two questions came up from the pool of people watching. One was, what is a reputable news source, or what are some? I still love Investor Business Daily, IBD, and it's, to me, it is reasonably a trustworthy news source. But if we go into the history of the stock market, which we will spare you, but from the creation of the Wall Street Journal, the Wall Street Journal was originally created by one of the Wall Street fat cats, and it was a medium used to manipulate the market to both short sell and to do pump and dumps on stocks. So I say that to say that historically there have been news medias created solely for the purpose of manipulating stocks. You want to be careful with news, because sometimes you'll get a owner or a CEO who's pretty familiar with a news medium, and they'll just ask them to literally post this article. Or we all know, if you're an adult over 35, you probably know now, there's a thing in business called pay to play. And you can get an article posted somewhere in a reputable source sometimes, but you pay for it. So it's really an advertisement that looks like a news article. So you have to be careful on what news you take in, because sometimes you're reading an advertisement, but it reads like a news article. So if you have never paid attention to that, it's a thing. It's a very real thing.
Yeah, and for me, like, if I'm looking at news, I'm not looking like I don't care about opinion pieces, right? I don't care if some guy on I don't know, Seeking Alpha or Yahoo Finance, if they're writing their opinion piece on what they think the company should do, what they think the company may have, the product. Opinion piece I don't care about. I look for factual data, right? So I'm looking for things on the company's earnings, past and present, announcements from the company as far as their products, maybe management change from the company. But those are like factual information coming out of the company. I don't care about opinion pieces. So if, like I said, if someone's giving their opinion on a company, what they think it should do, what they think stock may do, I don't look for that. I'm just looking for the hard factual information, and I judge off there. And like Brent said, I'm with him. Like, we both used to subscribe to Investors Business Daily. I still read, so they have a free. Their site is, a portion of it is free. So they have good information. They report the facts. They report earnings. They report stuff from management. So I still use that. And again, it's free, free to read. but that's, I mean, I look at I look at all of them. I look at CNBC, I look at Market Watch, Yahoo Finance, Investor Biz Daily. But again, I'm looking for the factual information, not anyone's opinion on the company.
Yeah, and I'll say for opinions, I do like Cramer. Jim Cramer, I just think he's a bit of a genius in the marketplace. So that's my opinion on Jim. Even though I'll say this, even when Cramer says something on Mad Money, I go look it up. So
no, yeah, I watch Mad Money. Yeah, I mean, I like Cramer for the exposure to. Like I'll tell you, I've made money off that show. Like he's mentioned the stock, had the CEO on. I've gone to research it and I bought it. Like I do that all the time. So yeah, I agree. Kramer's a good source of information. His show, Mad Money, but again, his opinion, I don't really care for. But I do like he presents. He brings new companies to the fore that I've never heard about before. Sometimes on his show.
Yeah, and sometimes I like the fact that it's the reality that people at his position have privy to dinner tables that we don't. And there's a lot of conversation happening at those dinner tables, some of which I feel like Cramer just kind of throws out there as entertainment. I'm sure most of it he doesn't. But every now and then he'll say, like, I had a talk on a fishing trip and you told me, and he'll call a CEO out when interviewing him. Like, the last time we had dinner, you said something totally different. Are you saying that your opinion changed? And because of that, I really like that. I respect him. But like I said, I wouldn't be surprised if they didn't have a conversation before this. And he said, look, I'm gonna hit you with this hard question. Is that cool? And the guy was like, yeah, or the woman was like, yeah. And so I do what Leon does. We watch, we research. One of the companies I like, but I am skeptical of is Motley Fool. And Motley Fool has a bit of a pay-to-play platform. And because of that, they also are, in my mind, this is my opinion. I don't know. I've never met the individuals. It seems like they have a relationship with certain CEOs that are their favorites. And because of that, they don't put out bad news about certain CEOs. And so I've kind of noticed that about their literature when they put out information, and it gives me pause. So I like Motley Fool, but I would do more research after watching or finding something of interest on Motley Fool than I would do if I found it on Mad Money.
Yeah, Motley Fool. I agree. They have some good articles, but a lot of their stuff that I've read, I noticed is a lot more opinion pieces. Like they'll present information, factual information, but then they'll overlay it with like the writer's opinion, and he'll give like this explanation of why he thinks this will happen or she thinks that'll happen. And that I'm just like I'm like, okay, you're just being you're putting your own bias into it versus just the information. So yeah, I would put Motley Fool at the bottom of the list, where IBD, Market Watch, Yahoo Finance are kind of and CNBC are kind of my big 3 or 4.
Yeah, and just the last example of that is JFrog, which is a company I like. But if you were to read the news on it, a lot of the news talks about JFrog's future potential and how they can be placed great in the marketplace and da-da-da-da. But if you look at JFrog's revenue, they've been positive 2 quarters after their IPO, which happened in September. But their revenue and cash on hand is nowhere close to one of their closest competitors, which is Microsoft. So you think about a new company like JFrog, and you're looking at the fundamentals, and you look at their competition from a dollar-to-dollar standpoint has far more operating capital than they do to put towards research and development and to get products to market faster. And then you combine that with the fact that JFrog's, I think their lockup period is ending sometime in March. And if you all don't know what a lockup period is, it's a period where the insiders who own shares, maybe institutional investor, employees, early investors, they can actually sell their shares. If you don't know that lockup period is coming because you don't know business, like you don't know stocks as well as you thought you did, and you didn't even think to look at a lockup period, because who does that? Like I never even heard anybody talk about a lockup period in regards to researching a stock. Yeah, you have now because you listen to Investing Education Academy. When that lockup period comes, Leon, you know what happens, right?
Yeah, the stock typically tanks.
Because a lot of people don't. And so I didn't even talk to Leon about that before here, but I know because of his acumen in the market, I can just throw that up and he get that served, right?
Yeah, boom, out the park.
Yeah, like people who really know the market know these things. And sometimes new investors or people who are trading on their own news and, just with like they're putting together USA Today article and something they read in Ebony, and they're like, okay, they both said this, so it must be good. They get slammed. They get slammed because, yeah, if you read about the trajectory is great for the company, but you don't know this lockup period is about to end in March, and you never looked that up. Nobody wrote about that. Some people will, I'm sure, but it's not popular. And then you wonder why the stock dropped 15%, 10%, and then you don't know whether to panic or if this is normal. If and then on the flip side is because Leon and I know the behavior of stock. If something like that happened and it dipped on the lockup period, we know that's temporary.
And we know that's a buying opportunity because if it's a solid company with strong earnings and strong revenue and strong operating cash flow, and PE is less important. But if those three are strong and it drops because of a lockup, because again, like we said about the split when Tesla and Apple split had nothing to do with the fundamentals. Nothing changed. Same thing with lockup. Lockup happens, a stock can tank, has nothing to do with the fundamentals. So once all those shares come to market and the market absorbs it, it'll then typically reverse and goes on its ascent again. So that's a buying opportunity if it's a strong company.
So if I'm looking at the stock, I wouldn't even buy it until then.
Right. If I knew a lockup was coming, yeah.
Because that's a strategy, and that's the things that we talk about, and we hope you all get when you all listen to us. Like maybe you never would have thought about that, but because you watched Investment Education Academy tonight until 10 p.m., you got it. So we're going to continue this conversation over on Clubhouse after we're done here for a little while over on Clubhouse. But we are going to get back to that schedule, going back over to Clubhouse after these lives. And if you're listening to us on the podcast every Wednesday about the 10 o'clock time frame, 9:45, 10 o'clock, we're going to open up a room in the Clubhouse, normally named after the information we presented that day. So we can either answer questions we couldn't answer otherwise, or get new people in with new questions. And if you were at our last one, I mean, we started talking about timber, how much price per tree is on a lot, government grants to acquire land. I mean, we got strategies to buy property, farmland, and also lots from grants that actually pay you more than what the price of the parcel was. It was crazy. It was insane. It was great information. But anyway, we owe you 2 picks. This is actually my pick, so it's already up. So it's Taiwan semiconductor manufacturer. And so this is going to go back to how you pick stocks, right? Right now, some of you all may not realize that in the world, there are semiconductor shortages, like large scale semiconductor shortages that are causing some companies to actually lose money. So like Ford, I think, had to shut down a division because of lack of semiconductors. And there are a number of other companies now that will do anything just to get more semiconductors in, which places Taiwan Semiconductor, TSM is the ticker symbol, in a fantastic space to take advantage of that. And let's take a look at the financials. Let's see. So you're talking about $1 billion in total revenue, and their total revenue looks like it's growing at about at least 200 million a year, roughly, like 30 million here and there. Year over year, this company has shown growth. They are starting to get stiff competition from like the Apples, Microsofts, but in AMD, and I think it's another one, Intel too. But I like them because the Taiwan Semiconductor has a strong history in the marketplace. Looking at the price, let me see the 5-year. They're currently trading $136.27 per share, which is currently down 2.7%. I want to talk about the market share, and I always talk about market cap. Market cap is something I look at a lot when trying to get an understanding of a stock. Taiwan Semiconductor, ticker symbol TSM, has a market cap of $568 billion. Let me say that again. They have a market cap of $568 billion. And let me give you a comparison to that to like a Zoom. So it gives some scale, right? Zoom's market cap is 125 billion. It's almost 5 times that. So it's not going anywhere anytime soon. And when you have market cap of that size, it gives you the ability to actually absorb the blows of short-term market hiccups. If you can absorb the short-term market hiccups, you can come back stronger. You can hire the right people. You have money on hand to make adjustments. You're not struggling. When small cap companies, and some of the companies we've looked at before had market caps of like 26 million. And we still thought they were good companies, but if something really goes wrong, they could disappear somewhat easily. So this is definitely a very strong company, strong financials, showing growth, and they pay a dividend. So if you're looking for a dividend paying company, this is it. Taiwan Semiconductor is my choice for today. Leon, what's yours?
And just real quick on Taiwan Semiconductor, this company is the company that the majority of semiconductor companies in the world use Taiwan Semiconductor to build their chips. A lot of companies, it's what they call fabless, FABLESS, which is the fabrication. They don't have any fabrication capacity because they outsource it to TSM, to Taiwan Semiconductor. And Intel, the largest semiconductor company in the world right now, is looking to outsource some of their development to TSM. So this company, cream of the creme de la creme when it comes to semiconductors and chips. And I've been looking at them, but I've been waiting for a pullback and it just hasn't come yet. But they're on my list. So my stock is a company named Qualys. Ticker symbol is QLYS. They are a cybersecurity firm. They have, pull some stats. So pretty impressive. They're in 130 countries. They've been around 20 years. I'm gonna just run through how wide the reach is. So 66% of the 66% of Forbes 500, 450 other customers, 64% of Forbes Global 100 other customers, 46% of Forbes Global 500 other customers, and 25% of the Forbes Global 2000 other customers. So huge reach, really wide, really broad. And been around 20 years. Few stats on them. They're three. Now we're going back to what we kind of talked about earlier, the fundamentals. Remember, I look at 3 years. So the 3-year average revenue growth is 16%, and the 3-year average earnings growth or earnings per share growth, using the terms we just brought up, is 32%. So and I always say this is that Wall Street typically says that a company that grows earnings or profits by more than 20% is a growth company. And this company is growing their profits or earnings at 32% clip. So Qualys would be considered.
Yeah, real quick, it has to be 20% for a certain number of years, right? 3 years, 2 years?
No. It can be well. That's the thing. It depends. Like there's no real standard for it. It can be quarter over quarter. It can be sequential, or it can be yearly.
Yeah, so it's kind of, it has to be it for it to meet the true growth. I think it has to be at least like 3 quarters, or if they're doing it by year, 2 years.
Okay. Yeah, there definitely has some sort of some time period there. Yeah, definitely. The 32% for Qualys is average over a 3-year period. So they would meet that standard of being a growth company. And that's my pick, Qualys. Ticker symbol QLYS.
Yeah, and again, looking at these companies, you still should do your research.
Oh yeah, always.
Whoever is watching, they're like, I really like what you guys say about these stocks. And granted, since we've started, our overall portfolio of picks is over 50%. But it's still one of those things you want to do your research. Make sure you're picking stocks that make sense for you. Make sure you have a diversified portfolio. If you are not a member of Invest in Education Academy, we welcome you to join. We have a number of people who I have joined this year. And actually, the cool thing is people are really consistently now buying Invest in Education Academy membership to family members as gifts. And I think that's the coolest thing in the world, to give the gift of financial literacy. And, one stat that I recently heard, I have not checked it. I have not fact checked it, but it was just startling to even hear. They said in Boston, please check this, whomever is out there, check it and shoot us a DM somewhere. In Boston, For every $274,000 a white household makes, a black household is making $8.
Wow.
That's crazy. That's insane. So yeah, it's just.
And I just want to make one point on the research thing. So like Brent said, our average return since we've been picking stocks on these podcasts since April of last year is right around 50% return. But a lot of those stocks are very volatile. So I mean, it's worked out over time, long term. But there are some instances in there where some of those stocks were down big. So some of those stocks may not have fit your suitability or your risk profile. So that's why we say always do your research, because you may pick one of these stocks that we pick on here on the podcast, and then you may look up one day and it's down 20%. Well, Brent and I know going in what we're getting into, so we're totally cool with that. So if you're not cool with some volatile stocks, again, do your research, make sure the volatility of the stock fits you, and if it does, you can buy it. If not, then you can move on to the next. But that's one reason to really do your research, just so you're not shocked by some of the volatility in some of these stocks.
All right, so we are going to join, or we're about to head over to Clubhouse to have a conversation about the market and investing in general. If you'd like to join us over there, please feel free to join us. Again, Leon's stock pick today is Qualys. Ticker symbol is QLYS. It's currently trading at $104. Well, as of the close of the market today, it was trading at $104.03. And as a timestamp for the people who are listening to this via the podcast, it is February 17th, 2021. So you know when that stock price was at such. And for myself, my stock pick today is Taiwan Semiconductor Manufacturing Company. Ticker symbol is TSM. It was trading at $136.27 as of the close of the market on February 17th, 2021. That is strictly a timestamp to be efficient and responsible. Everybody, again, we really do appreciate you all sharing these lives. We appreciate you giving us this amount of time to just kind of talk. But every time we have these conversations, our goal is that the listeners are further along in understanding the market and what their relationship with the market can be. And that's why we don't just go live inside of our community and we just keep this for community members. We do more in there, but it's not all we do, because the world and many individuals who aren't yet members, they really need to join the market, because what's happening as a COVID has accelerated the wealth gap. Mm-hmm. And there are a lot of people who are standing on the sideline like, oh, let me just stay close to my savings account. And I'm going to tell you, like, you're going to, even if you don't lose in the broader race, you're losing from the best version of your money. And that's what I'm going to start saying, because I used to be like, you're going to lose. And I think that's wrong. And it's a bit insensitive to say. And so if I offended anybody ever by saying that, I apologize. But I think an accurate thing to say is you're losing the best version of your money, because it is not happening in the savings account. And we're not even saying come join us. We're just telling you, get out. Because when this COVID environment is done, and we're talking about another 70 million people that are filing for unemployment, when the smoke clears and the government no longer has to support us as a community, there are going to be a lot of people without jobs, and that wealth gap is going to start feeling very real, because survival is kicking in. When unemployment stops and all these things stop, and the only way your money is going to grow is the market. I've had people who've been, with us for 2 years. They made $136,000 in a 2-year period, just total profit. I mean, it's all relative to how much they're investing and so forth and so on. So just understand that number in the isolation means really nothing. But that $60,000 per year that they made is almost equivalent to some people's salary.
Double some people's salary.
Yeah, and they made it just being in the market. I've had clients, and I told you this is me, who pay me certain things, and I've invested in, instead of like trying to put it into my account. That money has earned me 30%. How many of you all can walk into your job today and say, I want a 30% raise?
It doesn't happen.
It happen. But if your money is in the market, you know what you just did? You just gave yourself a 30% raise. Or you have the possibility
potential.
of giving yourself a 30% raise. you have zero possibility of giving yourself a 30% raise in a savings account. You just have to keep working for your money, and the cycle just goes over and over and over again. Please educate your kids, have them watch these, talk to them about their money. My daughter's birthday was today, and several people sent her dollar amounts that were significant. Every dollar she received already bought her Bitcoin. She didn't receive, she's not gonna go to the store to spend $1. She's not even gonna miss it. She turned 5. What does she need to spend money for?
But she gonna love that Bitcoin in like 10 years.
Yeah, so everything she received today went to buy Bitcoin. It's changing how we have a relationship with money with that next generation. So that's all I'm gonna say. But it's really important that you all, again, I don't care if it's us or whoever, change your relationship with money. Don't be afraid of the market. Don't be afraid of cryptocurrency. Educate yourself. Figure out what your style is, what your risk tolerance is. Overall, that's your suitability. And then invest according to that. So with that being said, everybody, have a great day. We'll see you guys in Clubhouse.
Join us on Clubhouse.